Hello everyone and welcome to the Like a Tortoise channel. My name is Eduardo, for those of you who don't know me, and today I want to talk about a potential bubble that is definitely, in my opinion, brewing in the US stock market. And when we talk about markets, typically people always emphasize the markets in the US because those are the most liquid, and that's essentially where most capital goes to. And I want to talk about these markets for. I want to take a step back and assess the market from a valuation standpoint. And what you can see right here is that this is incredible, guys. So the Shiller P ratio, which for those of you who don't know, essentially is based on average inflation adjusted earnings from the previous 10 years. So it just takes the earnings from the last 10 years, and so it's cyclically adjusted. And this ratio right here just surpassed 40 for the first time in about, 25 years? This is insane. Yeah, so the last time this ratio was at above 40 was in the 2000 tech bubble, and we all know what happened. Right now, we are at 40.8, and we continue our march out higher. And I mean, it's unbelievable because so many of us, and especially if you are a millennial like me, and if you started your investing journey, say 10 years ago, you are conditioned to believe that the stock market can only go up because we've never really experienced a big drawdown. The closest to it was back in COVID when everything was shut down and markets crashed, 40%, but they went back up a month later. So that's not a real bear market. And sure enough, I mean, this thing has been going up forever. So the question is, can it go higher? Do I think the market is going to crash? I'm not a forecaster. You know that I don't make any decisions based on macroeconomic events. Because I'm a fundamental driven investor, and I do believe that no matter how expensive markets get, you will always find pockets of the markets that will be undervalued. Even if they are not pockets, you will find one or two great companies, like a few handful of companies that can belong in your portfolio, that remain high quality, but they are temporarily mispriced due to a company-specific event. It's certainly not due to a recession, because certainly in this environment, if there is going to be a recession, it's certainly not priced into the stock market, judging by the valuations. But I mean, I'm a very conservative investor, and this scares me because you can see that the median is about 60, so we are well off those levels. And I think, to me, this is a big red flag, and it's not the only valuation metric that I follow. You can see, for example, the Buffett Indicator, which has currently is marking about 220%, and again, this already marks the highest valuation level in history, well above 2000 and 2007 levels. And even here during COVID, look at that. Even here during COVID, we were at 187%. Now we are at 219%, which is we are at nosebleed valuation levels. So the question is, I mean, is this going to continue? Because I can see more and more people buying indexes, and what shocks me is that people don't really understand what they're doing. But I think the passive investing has completely distorted how markets function. And not long ago, I created a post in our school community, and you can see that, for example, the title was "Still Think Index Investing is Not Risky." Think again. Right now, US index investors are playing with fire, and this was only 8 days ago. So I gave these two indicators as an example, and then I see people still believing that. So because the last 15 years have been great, they fall into the erroneous judgment of believing that the next 10, 50 years will be the same, right? And that is certainly certainly a big concern of mine, because what it tells me is that people are uneducated about how these things have panned out throughout history. So history shows us that actually buying into markets at egregious valuations often means waiting 15, 20 years just to break even. Yet trillions keep flowing into the S&P 500, often without investors asking what they are actually buying and why. This is what is distorting financial markets, and the risks continue to mount. And look, every single day we look at the stock market and it's green, right? I mean, it doesn't matter if Russia invades Ukraine. It doesn't matter if Middle Eastern countries are going into war over oil. It doesn't matter if Trump is putting out controversial policies. All factors simply don't matter these days, and it's like markets can only go up no matter what. And I think sooner or later, what this creates is this false sense of complacency that things can only play out the same way. And so I think it's very important now more than ever to stay educated, to stay disciplined, and above all else, to make informal investment decisions that are not impulsive. And remember, because your neighbor is getting rich, buying high flying or speculative names, that doesn't mean you should be doing that. Remember that over the very long term, what's going to dictate which ones outperform all others is how sound the framework, the strategy actually is. You can see people, and this will always happen. It has happened throughout history, and I'm a student of history, and will continue to happen. People will always feel compelled, right? They will always make these emotional decisions, and they will try to buy something that will likely get them rich over a short period of time, without thinking about the consequences that actually compounding can actually work against you. And so if things don't work out as you are planning, they will then it can take you many years just to come back from those losses, and that will greatly impair your investment returns down the line. So I think it's important for us to keep this in mind. And there are other things that cause me to remain very cautious, and frankly feel sorry for people who have no idea what they are doing, but that continue to plow money into the indexes with their hard-earned money. And you can see, for example, this is the Dow Jones all the way back to 1896 through 2019. You can see there are periods right in history where it could take you just 25 years just to break even. More recently, 12 years during the 2000 tech bubble. And this will continue to happen. This has been the most extended bull market in history, and the most vicious, certainly the strongest bull market in history already. It makes sense that we will likely see a very crippling bear market in the years ahead, and you should be prepared for that, especially if you are buying an index at an all-time highs. And another thing that is really concerning to me is how concentrated this index, the S&P, has become. So if I go right here, you can see periods of extreme concentration. This is great data that was put out. And you can see that in 2023, and certainly more so now, you can see the market cap of the largest stocks relative to the 75th percentile stock. Look at these levels. We would have to go all the way back to 1932 to see similar levels. We are right now going through a period of extreme market concentration. And this, again, is very dangerous. And I made a comment right here that I want to show you. Index is certainly a great solution for many people. The trade-off, however, is that by definition, it gives you average returns over time. And sometimes average can mean going 10, 15 years without making a new high. So we are seeing something like that risk right now. last year, for example, that the 40% of the S&P 500 returns have came from just 7 companies, the so-called Magnificent 7 stocks. So what this means is that when people buy into an index, they believe they are diversifying across 500 names. Actually, the index is market cap weighted. So this is a bet on a bag of between 7 and 10 companies to actually continue to outperform very well. All right. So you are heavily exposed to those expensive tech names. And what do you think will happen if they miss on earnings, or if what happens is, because valuations are so stretched, even if they miss revenues and earnings slightly, the stock market will not come down 1 or 2%. No, it will crash 20%. Okay, because growth assumptions are already built into the valuations, and so all it takes is just a small hiccup for those stocks to come crashing down. And because the index is heavily concentrated into these names, they can move the market. So even if 3 or 4 of these names come down, you will see the S&P go down substantially just on the back of that, of those companies being hurt. Okay, so again, stay conservative. Adopt. If you are following this channel, I believe you, like me, like to play it conservative, and certainly I don't want people to follow any sort of get-rich-quick schemes. In fact, many of the people that I work with have been burned because of that. But what I always emphasize is conservatism, discipline, and patience. If you have a sound framework, if you have the right discipline, you will make money. And look no further. You guys know that I'm always very transparent about about the portfolio that I started for like a tortoise. And you can see that this goes back to January 2024, so it's about 2 years old. And you can see that I'm achieving 32% annualized returns. And if you look at my positions, what do I own? Yeah, I still own higher quality companies based on, if we look at profitability metrics, again, I showed you guys this before. Let me go back. Look at this. This is my portfolio stats compared to those of the S&P. So all my companies have, on average, better returns on capital, better profitability metrics. They've compounded more attractively They've compounded at higher rates historically, and they are still priced cheaper. So higher quality companies priced more attractively. I think it's the recipe for long-term success. And sure enough, I do expect this outperformance to continue. Look, am I going to continue to deliver 33% returns over the next many years? I don't really know. I'm more than happy with 15%, because that means I'm doubling my money every 4 to 5 years and outperforming the S&P over the very long term. But the point that I'm trying to make is that with a portfolio of well-established companies bought with a margin of safety, you can sleep well at night. Okay? You can sleep well at night, because a lot of negative sentiment is already built into the prices, and in fact many of them are moving without making headlines, which is something that I absolutely adore. Which means that when they really start making headlines, everybody will be buying into these companies, and I will likely be selling. So I hope you found this the video insightful, and certainly that you've managed to take some important takeaways from it. And I will keep you guys updated as always. And so let me know in the comments if you like this video, if you want me to put out more content like this one, or any other content for that matter. Of course, let me know. And if you find it helpful, please share it with your own audience, friends, family, whatever. Someone who's feeling lost in the stock market and could greatly benefit from what I teach here. And look, we are walking the same journey together. So if I succeed, you succeed, and I'll always keep you guys posted very transparently. Speak to you soon. Have a lovely weekend.